Hey, everybody, Dave Hagan here. Let's talk today about 11 stock picking tips. That's today on the Financial Wellness Podcast.
Welcome to the Financial Wellness Podcast, Dave's weekly message to keep you on your path to the financial success. Here is your host, financial problem solver and talk show host, Dave Hagan.
Hey, thank you, Nick, and welcome everybody to TFWP, or the Financial Wellness Podcast, coming to you today from Lake Arrowhead, California. We've got Nick on the line here from San Diego. Nick, how you doing?
Doing great, Dave. As always, great to be here.
Good to have you. How's the weather down there?
Oh, it is beautiful. 78, sunny, looking out my window, not a cloud in the sky.
Nice, nice. Now, our engineer is coming to us from beautiful downtown Van Nuys, and I hear it's like 105, 106, something like that, out in that San Fernando Valley. So just glad I'm not there today. Let's talk about stock picking tips. You know, a few weeks ago, Nick, we were talking in episodes 320 and 321. Can you believe that? Episodes 320 and 321. Hard to believe.
Dave, it's hard to believe we've been together for 2 years, and it's been a beautiful time together.
There you go. Two and a half. Don't forget our anniversary. But we were talking with Ryan Steiger, who was the author of this book, The Dividend Hunter, available on Amazon.com. And we were really kind of enamored with the book. I mean, it's 130 pages of just plain simple advice on why and how to pick stocks, primarily looking for dividend stocks, which was kind of Ryan's twist on the whole thing. But in simple terms, in 130 pages, he talked about and defined stocks and markets and dividends and how to analyze stocks by looking at the balance sheet and the income statement and the cash flow statement. I mean, really good stuff. How to analyze a stock and how to consider whether you maybe want to buy that stock. But, you know, it takes some effort, it occurred to me, to learn this. As easy as he made it in his book, it still takes some effort to kind of think it through in your mind. And you really should learn that stuff, especially if you're going to use that information to invest your own money. Now, if you're into that, if you appreciate that knowledge, if you appreciate having that understanding and you dig it, hey, that's great. But it's not so great if you don't dig it or if you're busy doing, other things. So I thought that it would be interesting to do a show on, whether there's some alternatives. So that's the big question that we're going to answer here on the show today. Are there other alternatives? And well, we came up with maybe 11 different ways to pick stocks. So let's go down the list. How about number one? Get hot stock tips from Uncle Loose Lips Louie. What do you think there, Nick?
You have an Uncle Loose Lips Louie? Oh, my goodness.
That's a frightening visual.
Personally, Dave, about stock tips, I think stock tips are always great to receive. However, I am a firm believer in doing your diligent research before you invest your money.
Yeah. I mean, my response to that was, no. I mean, not really a good way to get your information. But, check it out, investigate. You never know. But I wouldn't really rely on Uncle Loose Lips Louie,
Yeah, I definitely agree with that. But maybe one tip out of 100, one tip out of 25 may be worth pursuing. So
maybe.
And maybe, but maybe, just put out a feeler, throw in $25, $50, and, if it goes up, then you can be happy.
Yeah. Well, but you don't know, you don't know what their motivation is. You don't know what their level of knowledge is.
Very true. I mean, very true.
You just don't know. And it's so enticing when someone says, Psst, I got the best tip. I heard this from the guy that shines my shoes. I just don't think you're going to get that kind of good information. I really don't think so. I think that's way too dangerous. That's just me. That's just me. But I would check it out. I would always check it out.
What's number 2, Dave?
Number 2, listen to advice that you overheard in the locker room at the club. No, first of all, we can't get into workout clubs anymore, right?
I was gonna say this must have not been written during quarantine.
Who does that? Who goes to? I don't think you can get in. We were talking a few minutes ago. If they have some outside area, maybe you can go work out. If there's only inside area, you can't work out. I don't know who would want to go to a, heavy breathing, hot, sweaty club in the time of the Corona V. What do you think?
Just speaking for myself, I wouldn't.
I wouldn't go a million right now.
I'll leave it at that.
Yeah, okay. But I mean, you're overhearing someone, let's say you are, and you overhear someone in the next locker and they're on the phone and they're going, hey, Uncle Louie, I got this great tip, buy, this. Well, I mean, you don't know the person typically. You don't know what their contact to the issue is. You have no knowledge of the people. You have no idea why that person might be advising that. I mean, I've seen people over the years that were pumping up their favorite stock with no real expectation that it was going to do well. They just wanted to try and pump it up. I don't know. I don't think I would ever do that. How about number 3, radio ads? Give me a break. Radio ads. I saw or listened to a radio ad and they were talking about, hey, invest in deeds of trust. And these are the investments that Buffett and all these people get. You can get double rates of return with no risk. I don't think it was a stock. It was more like an investment in real estate from what I could gather. But who would listen to that? I mean, the greedy side of you goes, yeah. And when you really start to think it through, come on. And they're advertising on the radio for that. How poor can that be? Have you ever heard that before, Nick?
No, but if I did hear correctly, you're saying I could get 100% ROI and in a short period of time. And my dad always told me if it's too good to be true, it likely is.
Yeah. No, I wouldn't listen to radio stuff. Now, there are some radio shows out there where, they talk about retirement and strategies and stuff like that. But, take that with a grain of salt too. That's not really an ad per se, but take that with a grain of salt too, because you don't know what they're promoting, what they're looking to do, et cetera, et cetera. You really got to think for yourself. Number 4, TV commentators. Well, I don't know. To me, it's the same as radio. I mean, the only guy I like to listen to maybe a little bit, I was just going to say, Jimmy Cramer, Mad Money. I like listening to him. I think his sound effects are, a little goofy, but I always like the kind of advice that he provides. So if you're going to listen to a TV show and learn some stuff, maybe not get tips, but learn some stuff, yeah, Mad Money, maybe not a way to go.
Man, I love Kramer, and just for Kramer, I'm gonna give a booyah. And Jim, if you're listening, please give me a shout out. But I think he's great. I watch his Mad Money show from 3 to 4 every day after I get off work. I think it's just pure entertainment. But when it comes to his stocks, this kind of goes back to number 1, in my opinion, on number 1, which is get tips from not Dave's Uncle Loose Lips Louie, but from Jim Cramer. Just take it with a grain of salt, do your own diligent research and invest from there.
Yeah, but I think he's got some good insight. I think he's been successful over the years. I appreciate his analysis. But you still got to spend the time to think through what he's saying and to see whether you agree and why you agree or disagree. It takes time and effort. It just does. Number 5, just follow Peter Lynch's Beat the Street book and walk down the middle of the mall and look for the busy store and buy stock in the busy store. What do you think about that?
I think it's pretty general. However, it's a similar strategy to how I'm investing right now. I just invested in Amazon and Apple before it went up this past week. And what I'm currently doing is I'm looking at kind of quarantine stocks where people are investing their money and spending their money during this quarantine, i.e. Amazon. People are ordering Amazon now more than ever. And I think that, seeing what's busy can be a very lucrative tip and can really help you out.
Right, right. I find it really interesting to know what what you're investing in. But for the listeners, I don't want that to be considered an endorsement
This
or a
is
recommendation. Not at
this
all.
is not financial advice. This is solely Nicholas Appel's only his strategy, only for himself.
There you go. There you go. When I was thinking about this, this Peter Lynch strategy, it seems to me it's more of a look at the big picture kind of strategy and then do your homework from there. So if you see something in the mall that's doing well, check it out. I mean, Toys R Us was pretty busy before they went out of business,
So was Brooks Brothers, so was CPK, so was every other bankrupt stock now.
Yeah, it's not the absolute indicator, but it's something to give you some ideas and start doing your research. But again, it takes time and effort. You've got to do your research before you execute on something like that. Number 6, research on the internet. Well, yeah, I mean, you can find anything on the internet. I'm continually amazed at the information that you can get on the internet. But like we've said time and time again, you got to consider the source of the information, and it takes time. It takes knowledge. It takes some mental horsepower to kind of think it through and see whether you agree or disagree. But yeah, you can get a lot of information on the internet. How about number 7, momentum trading? You know what momentum trading is, Nick?
I have no idea. Please inform me, Dave.
I talked to a fellow a number of years ago, and he was a pretty knowledgeable fellow, but he was momentum trading. And this was brought about by the fact that trades had now become so cheap or almost non-existent. And he says, look, I'm a momentum trader. I get up in the morning, I see what's hot or what's cold, and I will jump on the momentum of that stock. I don't care what they sell. I don't care if they're in trouble. All I'm going to do is if I see them riding up or down, I'm going to jump on board. And if I can get a little tiny piece of, profit from that,
right,
that's my happy day. So he would sit at his computer screen, I don't know, 3-4 hours a day looking for momentum and just jumping on board.
Actually, you know what they call a momentum trader these days, Dave?
Fool? No, what?
Yeah, you're along the same lines. They call him a Robin Hood trader. And basically what's there's a site called Robin Tracks, which I'm pulling it up right now, and it shows the correlation between how many new investors there are and how high the stock is going. And CNBC analysts have spoken about this several times, and many new investors, called millennial investors, are using the popularity of a stock's increase in population to purchase that stock. So it sounds exactly like what we're talking about.
No, exactly. But I think millennium traders millennials that are trading, they're not quite doing the hardcore, momentum move. They're watching a couple stocks. They'll ride it up a little bit. They'll get rid of it. I think there's a little more thoughtfulness than just pure momentum trading. What do you think?
Boy, you optimistic man, you.
I don't know. I mean, it seems to me you're just guessing. Is that car going to go forward or is it going to go in reverse? And, you could jump on a little piece of that movement. And maybe if you sat there all day and you jumped in and out and you had a quick internet connection and you had all day, and maybe you had some software. I think this fellow back in the day had some software that he had bought on TV or something. And, if you're doing all that, I guess you could make some money, but really you're guessing. It's like gambling, it seems to me. I guess if you're doing it for entertainment purposes, I mean, there's people out there that, just need some things to do and they find it very entertaining. But you got to be prepared to lose the full amount of your investment. You really shouldn't have a large piece of, um, um, your money in this kind of thing. You have to acknowledge that you're doing it just for kicks. Kind of a lot like we talked about the lottery ticket a couple months ago with you and Brian. Where you were saying, oh, it's not an investment. And we had a statistic that showed that a lot of people, that was part of their monthly financial plan. And we were kind of down in it. And Brian goes, no, wait a minute. If you buy a ticket, buy $2-3 of tickets or whatever, and you buy it 2-3 days before, that's going to entertain you with the thought that you might win for 2-3 days. So if you think about it as entertainment, your entertainment budget's not too high. Yeah, maybe, I guess. And we went back and forth about that. We had a good time talking about that, as I recall.
Oh, yeah, that was great.
But it seems to me it's the same kind of thing. I mean, if you're going to do it for entertainment purposes, it's not too large a piece of what you're doing. I mean, I guess. But I wouldn't recommend that, What about number 8, stockbroker? Nick is a millennial. Do you even know what a stockbroker is? They're not around as much anymore.
I think I only know what a stockbroker is because my mom was a branch manager for a brokerage firm. But besides that, I don't think there's much. There's some use, but not much, especially with brokerages like I don't know about Schwab, but TD Ameritrade and Robinhood that are allowing free trades at zero commission.
Right. No, it used to be you'd call up your broker or stop by and go, I want IBM at 32 1/3. And they would make some contact with their people on the exchange floor, and they would send a runner over to the pit, and they were, bidding it up and down. And if the runner could get it at that price, they'd go sold. And the runner would come back and get on the phone, talk to your broker. And then your broker would call you and go, well, we were able to get it at 33 1/3. That's how it used to be back in the day. Now
I just push a button, a simple button.
It's on your cell phone even. It's like, you could be sitting out on a boat somewhere and trading stocks, and there's next to no cost. I think the first trades I made when I first started doing this was, I don't know, was it $35 a trade or something? And then it went down to, $6.95 or $7.95 and $1.99. And some of the places that you're talking about, they just don't charge. They don't charge. So stockbroker, I don't know. That's pretty old school, it seems to me. I wouldn't be against it, although a lot of people got some, questionable advice from their broker. But I just don't think there's enough brokers around where you're really going to have an ongoing relationship with a broker. But they're still out there, I'm sure. Number 9, managed money. Well, that sounds good. My thought would be perhaps, but usually you're not going to be able to get someone to manage your money until you've got a larger sum to take care of. They have minimums. And some places it's $1 million, some places it's $500,000, some places it's smaller than that. But money managers, can be a dime a dozen. So you still got to do your research. You got to find a good one. Somebody says to you in the locker room, well, my guy got me 100% last year. Run.
Well, Dave,
run fast.
I have a question.
Yeah.
These money managers, they're a dime a dozen, but how much are they yielding on your investment?
Well, I mean, it varies from person to person, and of course, what their strategy is. Are they looking to invest you in income or growth or some other type of theme or flavor? It's hard to say. It's hard. It depends upon the individual money manager, but someone that's not affiliated with the big house, I always wonder about that. You hate to see money disappearing. You hear stories about that, although I'm sure the vast majority of people who have their money managed never have lost anything. But, it is a way to have somebody look at it. They're looking at it full time. You don't have to think about it once you pick the person and you tell them what your strategy should be. Maybe that's something to take a look at, but they will take a management fee. Usually it's about a little under 1% a year. Now, if they're doing great work, who cares? I know a lot of people have said, well, I'm not going to pay what I could do. Well, for 0.75%. What do you care if you don't have to spend the time studying and looking and doing all that stuff? Now, if you dig it, that's different. You don't need to pay anybody. But if they're returning better than the market, or when the market goes down, your stuff goes down less than the market, well, they're doing their job. But you gotta check them out, and that takes some time. I know a guy, maybe I've told this before on the podcast. He was working for a company that managed money, and he said he had a real problem. And that problem was that the year before they had returned, like, I don't know, 50, 60% on the money that they managed. So he'd walk into a new place and say, hey, I want you to come on board. And they said, well, what'd you return for your clients? And they'd go, well, 60% last year. And the knowledgeable people said, get out now, because they thought they were taking too much risk with their people's money.
Right.
And too much success can be a bad thing. And so it was really interesting to hear him talk about having a really good year and having that be, a problem for them. Were you doing stuff in the market back during the dot-com bubble?
Dave, I'm still young. Come on. No, I was not. I actually first started investing in the market during this Corona bubble.
Oh, really?
Back in late February, early March, and I've done pretty well since then.
I mean, I remember back in the day, I got it was like a booklet with charts that had performance of various funds at a brokerage house. And I remember seeing, golly, it was maybe a half a dozen funds that were up 100%. And you're looking at that going, oh, this is the best. If I can do 100% every year, I can retire in 3 years.
But of course, crazy.
We call it the dot-com bubble, and it broke, and a lot of people lost a lot of money. A lot of people made some money, but a lot of people lost a lot of money. And it was only a short-lived thing. And I think the dot-com bubble was a once in a lifetime kind of thing, seems to me.
Yeah.
But manage money as you get bigger. Manage money, I think, is something that you definitely would want to consider, but you really got to check out the folks and check out the people and make sure that you're kind of, in agreement with them. But something to think about. How about number 10, mutual fund? Now, you don't hear this so much anymore. You know what a mutual fund is, Nick?
Kinda. I believe a mutual fund is basically a large brokerage house. I think Bill Ackerman owns a mutual fund, and I believe they charge a percentage, and they're like a money manager for the most part.
Yeah. They run a fund, and this was a big thing maybe, 20, 30 years ago, very much in vogue. People were, not typically doing as well dealing with their broker and calling out individual stocks. And so people got together and put together a fund, and the fund was managed by a person or a team, and you would put your money in along with everybody else, and they would invest your money, and usually with a theme or a goal, like something to match the Dow or growth or income, or if you wanted a fund that didn't have oil stocks in it or something like that, or foreign investment, small cap, stuff like that. Very trendy back then. And it was easy. And it was the first time that people with smaller pools of money could have access to, good professional management. And there were tons of funds, and you could just pick the fund that you want, and you would go in and just watch it. So the work was picking the fund, making sure that you were, mentally in line with, the risk and rewards of that particular fund, that you liked the particular group of people that were running the fund, but you pick it, or like they used to say on TV, set it and forget it. But there's costs, there's cost to letting someone else do the thinking. A lot of these funds, especially the better ones, had a load going in. So you'd have to pay 2-3% going in, 2-3% going out. Now, I guess if you're going to invest and leave it there and it's going to go up over a bunch of years and it goes up more than the market, 2 or 3% going in and out isn't the end of the day. But there were a lot of people that said, stay away from mutual funds because, loads are dragging down your returns. I think Warren Buffett used to say this. And there are also costs. They charge a management fee. It's pretty small, 1.5% typically. And again, what do you care if they're great? But you're paying a management fee every year. You're paying a load in or out. You used to get them, I was going to say through the internet, but no, you'd get them at the brokerage houses. Schwab would have their mutual funds or funds that they were affiliated with, Fidelity, Ameritrade, all the different groups had a family of funds. And when you would go in there, you'd say, well, I want something really roller coaster-ish. And they'd give you a page with a list of all the, the hair blowing back kind of funds. Or you'd say, yeah, I got 30 years to work. I want something that's going to have some fairly aggressive growth.
Well,
go ahead.
Well, Dave, actually, real quick, going back to your whole set it and forget it quote, I think that's a really good segue into our next topic, which is ETFs, because as Mr. Buffett, our favorite Warren Buffett over here at TFWP has said, put your money in SPY, SPY, because it tracks the entire S&P 500. And over the years, it's provided or yielded a 7% annual return.
That's not bad. Not bad. But you're talking about an ETF.
Correct.
Basically. Yeah. So let's talk about that just for a minute so everybody understands what we're talking about. Think of ETF as kind of a robo investment. It's a computer program, and you put your money in and it invests your money mathematically to model a certain return or a certain group of stocks. So you can get an ETF that models the Dow or the Russell 200 or any number of things. But instead of a person doing it, it's a program that's doing it. Think of it like a computer-driven kind of mutual fund. There's people involved, of course. I mean, you've got to have someone there taking in the checks and writing the checks out. It's just that they're not making the investment decisions. The computer program is mathematically making those computer decisions. And there's no load typically, which is kind of nice. And the management fee is, like less than 0.25% annually. So the fees are less, and you don't have to worry about like the manager of the fund, running off with somebody or disappearing or freaking out or whatever. It's a computer program. Of course, that's good and bad too, right? If you're in an ETF and it's following, the Dow Jones, and the Dow Jones plummets a third, your investment's going to go down a third for sure. That's the way it's built. But if you're looking long-term and you're going to let it happen long-term, it'll go up. What do we say that over the last whole bunch of years, 40, 50, 60, whatever, the Dow's gone up an average of 10, 11, 12%. So maybe not a bad way to look at that ETF. When mutual funds were starting to fall a little bit out of favor or becoming a little stagnant, at least in the investment world, everyone thought that these ETFs were like, voodoo magic or whatever. And they did studies and they found that the ETFs typically would do as well as the mutual funds, at least in terms of the area in which they were investing. And then at a point, Warren Buffett came out and said, I think these are pretty good things. We ought to look at that. And that's when they really fell into favor recently. So, yeah, pretty good stuff. Pretty good stuff. So there you have it. You've got 11 different ways that, you can pick stocks. That's what we called this episode, but really I'm really only going to endorse the last 2 or 3 or 4. The others just strike me as way too, not a good idea at all. Anyway, let's sum it up a little bit. Start small, get a couple grand, get it in a savings account. When you got a grand or two, well, then maybe you can move it to a brokerage house. You can invest it yourself and read the Dividend Hunter and other books out there and do it all yourself. Or you can, when you get a little more, you can do managed money, or you can put it in a mutual fund, or you can put it in a ETF. I mean, there's all sorts of ways to do it. People ask me all the time, how do I get started? Well, the first way to get started is you start putting money in a separate account on a very systematic, programmed method. Every month you're going to move this amount, or every paycheck you're going to move that amount. So you just do it that way. And then when you turn around and it builds up, then you just walk into a brokerage house, one of these places, and say, I want to put my money in an account. And they'll set it up for you, whether it's a retirement account, whether it's a savings account, whether you just want to, get simple interest in, T-bills, or whether you want to do something a little more aggressive and invest in mutual funds or stocks, or whatever you decide that you want to do. But that's the way you do it. You start with a programmed, systematic way to put money aside. You put it in a bank account or a savings account, and you let it get some interest. And when it grows a little bit, then you start investing or managing, or take that kind of a next step. I put 11 tips because, hey, I wanted you to listen, and I wanted to keep Nick's attention, as a millennial dude. And,
come on, Dave.
You're doing this right now, Nick, right? You're in law school, but you're doing this.
I'm doing this. I have a little bit more of a risky strategy than what TFWP endorses.
Well, because
However,
you're young and you're excited about, and you're putting the time in to learn it.
I'm putting the time in, and no matter if you're looking for a small yield or big yield on your return, there's always going to be risks. I'm fortunate to be in a position where I can be a little bit more risky with my money. However, I do believe, at least to start out, to be safe with your money, get to understand the fundamentals of investing. It's also what the Dividend Hunter speaks about from Ryan Steigar's book. Start small, be safe. Once you get the fundamentals, then reassess your situation.
Yeah, and stick to your guns, By the way, is that book available on Amazon?
It's available on Amazon, Dave.
I got to tell you, I had a real interesting, talk about an investment war story. Just this last week, Apple went up a really significant amount. And you look at your program on your iPad, and you look at what you made in a day, and you go, wow, holy God, look at that. That's incredible. But if I had all of my money in that, I would have made that much more. And then you step back and go, yeah, but how stupid would it be to have all your money in Apple? You know what I mean?
Well, what's that quote from Wall Street, Dave?
You tell me.
Gordon Gekko?
No, greed is good.
Greed is good.
But you can't get too greedy. You got to stick to your guns. And, I'm starting to throttle back a little bit and not have as many aggressive investments. And that's just appropriate for me at this particular time. But, it's like when you see someone hit the jackpot at Vegas, you go, yeah, I want some of that.
but also being cautious is also good.
It's also good. Having it is good. I've sat down with a couple people over the years, and they said, oh, I thought that this particular company was definitely going out of business, and so I bought it short, and I was going to be rich in 2 days. And then something happened, and it turned around. Didn't see that coming, and it wiped me out. And, we're filling out bankruptcy paperwork. So no one should ever have everything in one pot. They shouldn't be aggressive. They shouldn't be picking aggressively or too aggressively, and not be prepared to, lose what they're investing. Some of these are the things that our good friend Warren Buffett's talked about over the years, time and time again. So, if you're looking back at the big picture, looking back to our, 5 tips to financial success. First, you want to get all your debt paid. Secondly, you want to put your emergency fund in place. 3, you want to start your savings for your retirement, setting money aside. 4, start putting the money together into what I'm going to call a wealth fund. It's for long-term stuff, like if you want to buy a home, if your kid's going to need an education, if it's going to help you with your financial independence goals. Those are the steps that you want to go through. I find it interesting when I talk to people and they say, well, I want to invest in this and that and da-da-da. Well, do you have debt? Yeah, I got all this debt. Well, you really should clean up the debt before you start investing, and certainly should have an emergency fund. But it's been interesting. It's been interesting the last, year and a half, huh, Nick? Stock market was up 30% last year, and then it went down 30% in March, and now it's back. I mean, not all back, but substantially back. It's crazy what we've seen.
I still think we have a while to see what's going to happen. I mean, look at the vacation stocks. They haven't come back yet because we don't even know what's going on with the Corona V. And until we have a greater lookout on the vaccine, I think there are some stocks that have worked their way back, but I think it's still a long way, Dave.
Yeah. Although, if one of our new people on Mount Rushmore, and he was saying, look at the big picture. He says, is it a stretch to think that when people are buying stuff from home that Amazon stock is going to go up? I mean, it seems kind of obvious when you look at the big picture like that.
That's my philosophy.
It doesn't always happen, but it seems pretty obvious. And that's why I appreciate Kramer. Hey, look at the time. We're way out of time, but I had a good time talking about this stuff. How about you?
Time flies when you're having fun, Dave.
No, I love it. All right. So next week, we're going to talk about maybe what your retirement might look like. For some of you, that's a long way off, but it's time to start thinking about it. Come back next week and we'll see you then. This is Dave Hagan, and you've been listening to the Financial Wellness Podcast.
You've been listening to the Financial Wellness Podcast, Dave's weekly message to keep you on your path to financial success. If you have a question that you would like Dave to answer on the podcast, go to thefinancialwellnesspodcast.com. You can leave an audio message with one click of a button, or type your message into the question box. Either way, it's sent right to Dave's phone. Remember, Dave will randomly draw from the submitted questions and pick the winner of a free 1-hour personal conversation with Dave to help you achieve your financial goals. Don't forget to subscribe to the podcast so you receive the new episode notifications, or share the podcast via the app with your family and friends. This is your announcer, Nick Appel, wishing you every financial success.